For years now, some of the biggest and best funded companies on Earth have been driving the AI boom to unprecedented levels. Then, in the space of a single month, they all headed for the exit at once. SpaceX went public in the largest IPO ever recorded, with Anthropic and OpenAI filing their own paperwork within days of it. And the moment SpaceX hit the public market, it rocketed to a $2.7 trillion peak before shedding more than $900 billion from that high within a fortnight, with the other two now getting cold feet. So, when the people holding the most information and having the most to gain all decide to cash out within weeks of one another, that tends to tell us something about where we are in the cycle. So today, I want to walk through why this AI boom is starting to look an awful lot like 1999, highlight the warning sign we need to be paying very close attention to, and warn you why the window to get out may already be closing. My name is Guy, and this is the Finance Bureau. In a single 3-week stretch this June, 3 of the most valuable private companies on the planet all moved towards the public market within days of one another. On the 1st of June, Anthropic filed a confidential S1. On the 8th, OpenAI filed its own. And on the 12th, SpaceX actually listed. And SpaceX didn't just list. It priced at $135 a share, raised roughly $85.7 billion after going live, and completely obliterated the previous record. The former champion was Saudi Aramco, which raised around $29 billion when it went public back in 2019, barely a third of what SpaceX pulled in. So, when people call SpaceX the largest IPO in history, they aren't exaggerating. It's the biggest pile of cash any company has ever pulled out of the public markets in a single go. Orders reportedly topped $350 billion, leaving the deal something like 4 times oversubscribed. And for a few days, the hype looked entirely justified. The stock opened, ran hot, and by the 16th of June, it touched an intraday peak of around $225 a share, a level that valued SpaceX at roughly $2.7 trillion. And then it rolled over, handing back close to a third of its value from that peak within about 10 days. Now, to be precise, the stock is still trading above its IPO price as I record this, but the retail euphoria and the fantasy premium that came with it have largely evaporated. And the trigger was almost poetic because reports suggest that having raised more money than any company in history, SpaceX promptly went looking for additional debt to fund its ongoing AI infrastructure build-out. That is the pattern you tend to see at the top of a cycle. Insiders monetizing while the appetite is still there, then reaching straight back into the market for more. And then, just recently, the Bank for International Settlements, the central bank for central banks, published its 2026 annual report, and it did something striking. It lined up the AI build-out against 4 previous manias: the canal mania of the late 1700s, the British railway mania of the 1840s, the electrification frenzy of the 1920s, and the dot-com boom of the late 1990s. And it identified the same thread running through every one of them, because each began with a genuine technological revolution, and, in each case, the capital being shoveled in raced far beyond anything the actual returns could ever justify. Which is very much akin to the situation we're in now. The technology behind AI is entirely real, but the money being deployed has detached from the underlying economics. The 5 biggest hyperscalers, Alphabet, Amazon, Meta, Microsoft, and Oracle, are projected to spend more than $1 trillion on AI capex across 2025 and 2026. And the BIS makes a salient point. That spending is now outrunning the company's own earnings and free cash flow, which means they're issuing debt to cover the gap. Layer the valuations on top, and the numbers start to look historic. Now, Goldman Sachs runs a proprietary bubble indicator across 9 different metrics, and right now it's sitting in the 86th percentile. And for context, the 2021 peak hit the 95th, and the dot-com top in 2000 reached the full 100th. So we're high, but not yet maxed out. And even Goldman's own strategists describe the market as frothy rather than a full-blown bubble. However, the more troubling issue is concentration. The top 10 companies in the S&P 500 now account for roughly 40% of the entire index. And to see how abnormal that is, you only have to look back, because from 1990 all the way to 2015, that figure sat between 18 and 23%, meaning it has essentially doubled in a single decade, a shift analysts have taken to calling the Great Narrowing. There's a divergence there too, because those same 10 names carry about 41% of the index's weight, while generating only around 32% of its earnings. So the weight has run well ahead of the profit. Research from TD suggests those 10 stocks now account for nearly half of the entire index's volatility, which means the diversified retirement fund most people think they own has become a concentrated bet on a handful of AI names rather than anything remotely diversified. And the Shiller-Cape ratio, a long-term valuation gauge, has climbed to around 40, a historically extreme reading matched only once before at the dot-com peak in 2000, when it set an all-time record of roughly 44. The 1929 pre-crash peak, by comparison, carried a CAPE of only about 32, and, well, you know how both of those episodes ended. Now, it should be said, a bubble rarely bursts everywhere all at once. It tends to start with hairline fractures at the edges in the names most exposed to the spending, and a couple of those fractures are already showing. Oracle just had its worst week since the dot-com bust of 2001, falling roughly 19% in the week ending the 27th of June, and the reason why is a near-perfect snapshot of the whole mania. Oracle's capital expenditure for its 2026 fiscal year surged 162% to around $55.7 billion. Its long-term debt climbed to roughly $130 billion. Its free cash flow ran negative by about $23.7 billion. And it cut 13% of its workforce, some 21,000 jobs, citing AI efficiency. And, intriguingly, Oracle's single largest customer for its AI cloud infrastructure is OpenAI. We'll come back to that in a moment, though. Then there's Cerebras, the hottest semiconductor IPO of the year, which listed in May at $185, opened at $350 for an 89% pop on day one, and then reported earnings. Its guidance pointed to a steep decline in gross margins, the stock duly slumped, and by late June it had fallen more than half from that opening price, touching a low near $160 before a small bounce. And while that was happening, several executives filed to sell shares, technically routine sales tied to vesting rather than panic, but exactly the kind of optics that unsettle a nervous market in the middle of a collapse. None of that, though, explains the mechanism. Why has the spending detached so completely from the returns, and what's inflating these numbers from the inside? Well, the BIS describes what it calls a complex web of private arrangements, and it works like this. A chip maker or a hyperscaler takes an equity stake in an AI lab, and that lab then signs a multi-year contract to buy chips or computing power from the very company that just invested in it. The money goes out as investment and comes straight back in as revenue, makes a round trip, and the supplier books that round-trip cash as growth, and according to the BIS, the terms of these deals are usually poorly disclosed. Which means the customer demand everyone is pricing into these stocks is, in part, demand the suppliers are manufacturing for themselves. Going back to Oracle for a moment, its biggest AI customer, OpenAI, posted a net loss of $21.3 billion in a single quarter and isn't expected to break even until 2030. So, you have a company drowning in losses, propping up the cloud revenue of a company taking on $130 billion of debt to build capacity for it, each leaning on the other while both burn through cash. And if that feels familiar, then it should, because we watched almost exactly this movie in the late 1990s. Back then, telecom companies poured more than $500 billion into fiber optic infrastructure, and the equipment vendors, Cisco, Lucent, Nortel, lent billions to cash-strapped startups who used the loans to buy equipment from those same vendors, who in turn booked it as revenue while their share prices soared and everyone looked like a genius. This cozy little arrangement held right up until the startups ran out of money and stopped buying. And when the loop broke, the revenue didn't shrink so much as vanish. WorldCom collapsed into what was then the largest bankruptcy in US history. Global Crossing went down with it, and somewhere between 85 and 95% of the fiber they'd laid sat unused for years. Dark fiber, capacity built for demand that never arrived. The 2026 version maps onto 1999 almost line for line. Equity stakes in place of vendor loans, compute contracts in place of equipment orders, but the same closed loop, the same inflated revenue, and the same fragility hidden inside all of it. And by the way, if you want to keep track of stories like this that affect your paycheck, portfolio, and pension, then you should check out the Finance Bureau newsletter. It's free, and in it we break down the latest in markets, monetary policy, macro, and more, so you never miss what matters most. Just click the link in the description or scan the QR code on screen to get started. But hey, perhaps we're being a bit too doomerish about AI. Today's hyperscalers are not the hollow dot-com shells of 1999. Microsoft, Alphabet, and Meta throw off enormous free cash flow, they pay dividends, they buy back stock, and they sit on real businesses underneath the AI bet. And unlike that fiber glut, current data center utilization is running at around 80%. So there is genuine demand here rather than empty warehouses waiting for someone to put something in them. The worry is about the spending at the margin, the incremental overcapacity, rather than the whole edifice being empty. And even Goldman, sitting at that 86th percentile, points out that the forward valuations on the AI leaders are roughly half what the tech giants commanded at the 2000 peak. So, the more useful question perhaps isn't whether we're in a bubble, but how a build-out this size actually comes back down to earth. Now, the sharpest framing here comes from Victor Schvetz at Macquarie, who argues that global AI investment in 2026 is running dramatically above any previous technology build-out on a comparable timeline. Bigger and faster than the railways, the canals, or the dot-com boom, and who thinks it won't end in a single dramatic crash. Instead, he expects it to deflate through a series of rolling bubbles. Hardware surges and cools, then infrastructure surges and cools, then the software layer, each subsector popping in turn while capital rotates into the next rather than fleeing altogether. So the broader market absorbs the shock. In his words, there's no reset button, just elevated volatility and serial repricing, which is, strangely, the optimistic scenario. Years of pain, but survivable and even profitable if you can read which sub-bubble is next. The BIS, though, sketches a darker path because that same circular financing has wired everything together. If a single major AI lab defaults on its multi-year compute commitments, the revenue at several chip makers and hyperscalers disappears all at the same moment. The private credit funds that finance the data centers face collateral shortfalls, and leveraged hedge funds become forced sellers. The BIS calls this the sovereign financial stability nexus, the point at which the shock spills over into government bond markets, the 2001 telecom crash, but with 2008-style contagion layered on top. So, the two roads in front of us are a slow, rolling deflation that gives us time to reposition, or one sudden system-wide rupture when the loop finally breaks. So, bringing it all the way back to where we started. The bubble isn't deflating because AI is a hoax. The technology is real and the productivity gains will eventually come. No, it's deflating because the financing turned circular, the valuations detached from earnings, and the smartest money in the room timed its exit. SpaceX got out clean, raising more cash than any company in history right at the peak of the enthusiasm, and the other two seem to have watched it happen and hesitated. OpenAI is now leaning towards pushing its listing all the way out to 2027, with Sam Altman reportedly calling any valuation below $1 trillion a non-starter. And on the day that delay leaked, SoftBank, which holds a $65 billion stake in OpenAI, fell more than 12% in a single session, wiping out close to 5.6 trillion yen on the rumor alone. OpenAI's own advisors are said to be pointing to SpaceX'S wobble as a cautionary tale, so the first one out the door might well have scared the next two back inside, and they may have just missed the window. Whatever the case though, as long as the AI mania continues, there'll always be questions about whether or when it'll all end in tears. Right then, how do you think this all ends? Am I being too negative about the AI trade, or is the mother of all crashes coming our way? Let me know in the comments. Okay, thank you all for watching, and I'll see you again very soon. This is Guy, signing off.